I'm going to jump in and introduce our speakers today from Plante Moran. We've got John O'Connor. John is a partner with in the Chicago office. Felicia Banks Donaldson is a principal. She's joining us from beautiful Archbold, Ohio today. And Kara Fahrenbach is a senior audit manager. So John, will you take it away and will you give us just a little bit more color, each of you, when you speak about on your background?
Oh, excellent. Wow. Thanks, Marty. That was great. So I'm John O'Connor. I'm a partner at Plante Moran. It's great to be here, and it's great to see a lot of familiar faces and names, clients, former clients, colleagues that I've worked with over the years. So it's great to be here, and thanks again for the invitation. Plante Moran is proud sponsors of FEI Chicago, so we will be at the CFO of the Year. Virtually is fine. One of the great things I think about FEI that it's done during COVID was some of the out of the gate virtual networking that I participated in. A lot of us participated in. It helped us to stay in touch. And while not the real thing, the next best thing is just fine. So just a little background on the firm. So we are a middle market, full service accounting firm. We have about 600 professionals in our Chicago offices and our office in Schaumburg. I'm actually on the call today from our office at 10 South Riverside, right near the train stations. And I've been pleasantly surprised over the last few days at the number of people that are in the office. Even right now, it almost feels like a normal setting. So it's good to see things kind of return to normal. Our kind of profile target client, or our profile client, would be a middle market company in the $50 to $150 million space. We help with the annual audit, tax services, owner services, estate planning, strategic planning around international expansion, ERP solutions, things like that. So we are a full service accounting, tax, and consulting firm. Today is 9:30. I'm sure everybody knows that, but we are in the CPE red zone for CPE credit. And if this is your 120th hour, we're very pleased that you spent it with us. So thanks again. And if you're still short, well, good luck. There's still, I guess there may not be time, but we appreciate the opportunity to help you get there. I know I just made it last week, but either way. Before I get to Felicia and Kara, just 2 minutes on me. I'm born and raised Chicagoan. I'm a DePaul grad. I have 30 plus years serving middle market companies in public accounting firms, Deloitte, KPMG. I've been at Plante Moran now for 20 plus years. And it's just a great experience to work with different people and different clients and learn every single day. So that's why we're here again today. To learn some more, both from this presentation and then from each other as we, pick up the conversation going forward. So maybe with that, that's just me. So Felicia and Kara, maybe I'll pass it along to you, just give some bios, and then we'll get into the content.
I'm Felicia Donaldson. I am a principal in our Risk and Accounting Advisory Services group. I primarily focus on the accounting advisory services, particularly opening balance sheets, financial merger integration work, as well as serving from CFO down to kind of like the analyst level when companies are experiencing change. I have a combination of large public company experience as well as Big Four experience. So a lot of experience sitting in the chair, and I think that that's what our group is able to add, the value of understanding the pain points of what it takes to get the books closed and trying to figure out practical solutions that will help companies going forward. So that's a little bit about me. Kara?
And I am Kara Fahrenbach. I'm a senior manager in the audit practice. I focus mainly on the manufacturing and distribution industry. I also carve out a fair amount of my time to the professional standards group and am the industry technical specialist for manufacturing and distribution. Prior to coming to Plante Moran, I started my career in the Big Four and then spent the vast majority of my career at a local Chicago firm before making the wise decision to land at Plante Moran. So with that, I will pass it back to John, who's going to take us through some COVID-19 considerations.
Okay, cool. Thanks, Kara. Thanks, Felicia. So where we want to start, it wouldn't be a remote presentation unless we, address some matters relative to COVID-19. And we'll start with the PPP accounting and kind of the implications of that. I think everyone pretty much knows the history that PPP were applications occurred mostly in 2020. Some forgiveness occurred in 20, but we saw most of the forgiveness kind of ongoing into 21. And there's no really authoritative GAAP on how to account for grants and subsidies like this for for-profit businesses. So it's a little bit of an accounting election where there are really three different alternatives. So 470 is mostly what we've seen, which is the company takes the PPP loan and then it resides on the balance sheet until it's forgiven. The other, I'll say alternative is treated as grant income under IAS, where it comes in as a grant and hits the P&L when received. And then non-for-profit companies treated it a little differently as it hits the revenue side of the P&L as costs are incurred related to the particular effort of the non-for-profit. So we're still seeing some, I would say we're still seeing a lot of forgiveness coming in to the P&L as we sit here in September of 2021, but we'll be dealing with the forgiveness aspect of it as we get into year-end closes and presentation for our audits. The point we wanted to make here is that, you may unknowingly have locked into an accounting policy that is a challenge to change. So if you're doing it traditionally under ASC 70, that's the easiest route. But if for whatever reason you wanted to go back and change the accounting into either grant income or if you're a non-for-profit, there's really limitations around that because, as we all know, to change accounting policies, you have to move. It has to be to a preferred accounting policy. And generally what we have found is that moving from ASC 470 to one of the others isn't necessarily preferred. So that's a little bit of a challenge. So if you're considering changing or have talked about changing, there might be some roadblocks in there as you kind of execute that policy change. The other point is just, kind of obvious, but these PPP loans are subject to audit. So you want to make sure, even if you have the forgiven documentation in place, that you hold both the application and the forgiveness and all of the supporting records behind it. We're starting to see some noise around some audits. Maybe amongst this group, there have been some audits that are underway. I haven't seen any personally, but we are starting to hear rumblings that notices might be surfacing. So be on the watch for that. And if you've applied, properly and gotten through the forgiveness process, hopefully it's just a matter of providing that information to the auditor. The next slide, Kara. So these are just some other, again, COVID-19 considerations. So impairments was a big deal in 2020. It feels like it's less of an issue in 2021, either because you kind of escaped the trigger event year, or maybe you had an impairment charge and it's just less of an issue this year. But it's still, if you're sitting on a lot of intangible asset or a lot of machinery and equipment, you may still be looking at impairment considerations going forward. Lease concessions is a little unique. There's not really any new GAAP around it. But if your landlord gave you a concession because of COVID, there is some simplification on how to treat it. And you can treat it either as a modification or not as a modification. So you can kind of run the numbers and see what works best for you and then kind of go down that path. And that was the simplification effort around that. Going concern, I think, again, this was a big issue last year. It feels like it's less of an issue in 21. We're seeing really strong performance within our client base, almost across the board in terms of, profitability and cash flow. But going concern is, always a challenging issue when you have to deal with your auditors on that. I think just it's not a GAAP departure. It's not a death sentence. It sometimes can be easily explained if you're dealing with, a lender who understands what it really says. And the going concern opinion really just is an emphasis of a matter about uncertain future events. And it's just the audit firm's opinion sometimes to get through the process. And audit firms do take it seriously, and we tend to be a little conservative on that. So it still may be an issue into 2021 as we're still kind of shedding COVID. Debt modifications and covenant violations, obviously that's a carry forward issue if you're in violation. Still require analysis if there were modifications on whether or not it's modification or extinguishment, which is kind of a heavy lift technical scrub of the application of the modification. We're still seeing the footnote disclosure hang out a little bit. My guess is that that's going to dwindle, that we may see fewer. I think every company that was audited last year likely had a COVID-19 disclosure. I think if the company is emerged from COVID favorably, I think we're going to see less of these COVID disclosures, or written a little differently where maybe they just address the specific risk. And then the last point relative to employee retention credit, a lot of companies have applied for that. A lot of companies are getting that credit. So the accounting for the credit is a little unique. It's almost similar to PPP grant income, or grant income, I should say. It doesn't go against your payroll related taxes expense. It's treated as a grant, and it's not income tax accounting, so it's separate from 842, but government grant, and goes through the P&L generally as grant revenue or other income. So it's not a contra expense for future payroll taxes. So that was all I had on the COVID accounting update. Maybe Felicia, I'll turn it over to you to talk about just some of the other highlight matters before Kara picks it up with leases.
Sure, John, thank you. So our first one is really related to some targeted improvements related to variable interest entities, or VIEs. This is effective for calendar year 2020. And this is the PCC, Private Company Council, VIE alternative that applies to all potential VIEs under common control. So not just your leasing entities. So the thing here is that this could have a significant impact on any company that currently uses the PCC leasing VIE alternative to exclude their leasing VIE from the financials. And if that company has other VIEs that are being included in the financials. So, the new standard would indicate that all potential VIEs would need to be treated similarly rather than this divide. So you can no longer pick and choose which VIEs you're going to present into your financial statements. The other thing here is that, common ownership doesn't necessarily mean common control. Related parties are not necessarily under common control. So you really have to do the analysis to determine whether or not, common control exists. So the takeaway here is really, you can't pick and choose which VIEs get consolidated. So that's this slide. Our next slide is really related to the reference rate reform. The LIBOR rate is expected to be phased out in June of 2023, at least that's the expectation now. Many contractual arrangements use LIBOR as the reference rate. So many of these contracts will require modification unless the provisions already contemplate a change in the reference rate. So this is for, this could be a hedging contract, it could be a debt agreement. So generally the change in a reference rate in a contract would require entities to apply modification accounting guidance to determine the appropriate accounting when there's a change in the reference rate. Given the prevalence of LIBOR as a reference rate in many contracts, such as debt agreements, lease agreements, derivatives, the list goes on and on. The time and effort needed to apply modification accounting to all arrangements would require a change in the index rate. And that would expect it to be pretty significant. So in response, the FASB has issued ASU 2020-04. And this rate is geared to simplify the accounting for changes in the reference rate if certain criteria are being met. This ASU only applies to contracts, hedging relationships and other reference rate, LIBOR, or another reference rate expected to be discontinued because of rate reform. So if you have a contract and it doesn't allow you, it only is tied to LIBOR, you can, hopefully take the simple approach and apply this simplification of the accounting. If otherwise, you would have to apply the modification accounting guidance. Next slide, Kara.
Sorry for my mouse seems to be acting up on me. So sorry for the switching back and forth a little bit there.
Has a mind of its own.
Yeah.
The next one is really accounting for implementation costs and cloud computing arrangements. So this is effective for 12/31/21. It's for any entities currently using cloud-based software. This would require any implementation fees related to that software to be capitalized going forward. This is generally preferred, for companies. So I don't see a lot of heartburn over this one. It's just that knowing that this guidance is out there now, and whereas previously it was gray, so companies would have to make a policy election to determine how they wanted to recognize. So I think that this one is a move in the right direction that makes it easier. So
sure, we've got a question.
Okay.
Do application migration costs qualify as implementation costs? Do application migration costs qualify as implementation costs?
Typically, yes, unless you're past it. Typically, yes.
Okay.
Okay. So our next slide is related to credit losses. So some of the common financial instruments impacted by the standard are trade and accounts receivable, loan receivables, held to maturity, debt securities, and net investment in leases. So this guidance requires entities to record an allowance for the estimated lifetime credit losses at the time the asset is created. And this is really the change here. It's really a change in, historically that's recorded, as estimated losses when they are incurred. So entities with long-term receivables are expected to have the most significant impact from the standard. However, with short-term receivables, we would need to assess the impact of applying this new standard. And this is effective for all entities beginning after December 15, 22. Oh, look like we have some more questions, maybe.
I have a question. Have you seen many clients adopt the CECL standard yet?
Not in my client base. I work a lot with middle markets, just like John and Kara. So not in my client base, not when it comes to the trade receivables. People are still kind of, using the old approach, I would say.
Yeah, I would add to that, Felicia. I think banks have been doing it. It's ongoing with banks. CECL is closer to IFRS. So companies that report under IFRS are doing, more like that. I think to Felicia's point, kind of in general mid-market businesses, we've seen less of it.
So I guess my real question is, I've looked at the CECL pronouncement a bit, and I know, John, to your point, financial institutions were doing some, some of them were very complex econometric studies and things. And obviously the vast majority of people on the call have, looked at their aging buckets and determined a percentage and come up with their loan loss provision. And, you know, I guess I was hoping you might say, yeah, you've seen companies do it this way or use this index to kind of gauge, you know, where they should set that loan loss. And I guess I'm kind of at a loss at, you know, how do you even start for, you know, just basic trade accounts receivable?
I mean, that's a great question. I think the best I could do, Marty, is, and unless Felicia or Carrie, you have anything, is the financial institutions have been doing it. And I think as we move into Q4 here, we're going to learn from what they've done in terms of how to apply this.
Okay.
And we can share that, you know, we can talk at any point on that.
Yeah, I would say as you see something, you know, maybe we could, if you send something to Susan and we could get that out to maybe people on this call. And yeah, I haven't seen much at all, and kind of at a loss because I know I'm going to have to implement it at some point in time here too. So
Yeah.
okay, thank you.
So I'm going to cover ASU 2020-06, which is the Simplified Convertible Instrument Framework. So this new standard significantly simplifies the accounting for certain convertible debt and preferred stock instruments, as well as contracts in a company's own equity. So previously, the accounting for convertible instruments depended on its terms, and there were one of 5 models that were used to account for the proceeds from issuing a convertible instrument. FASB simplified the accounting by eliminating 2 of the most complex models. And as a result, many convertible instruments will be accounted for as if there were no conversion feature, and interest expense on convertible debt will be closer to the coupon rate. Determining whether the freestanding contracts should be classified as equity when you've got a contract in a company's own equity requires evaluating settlement optionality and the conditions necessary for share settlement. The new rules eliminate 3 of the 7 conditions for performing this assessment. So more contracts will qualify for equity classification. Because the new rules account for many convertible instruments as a single unit, the board amended the EPS guidance to require companies to use the if converted method for all convertible instruments when computing their diluted EPS. And finally, as expected, there are more disclosures and more information is required about the terms and features of convertible instruments and the events and circumstances that could affect the amount or timing of future cash flows. The rules do apply equally to public and private companies. Companies most affected by this new guidance are likely those who have issued or plan to issue convertible debt with cash conversion features, or convertible debt or preferred stock with beneficial conversion features. Implementation is not required until January 1st, 2022 at the earliest. However, companies may early adopt, and we saw public companies take advantage of this because it does significantly simplify the accounting. We definitely continue to see companies take advantage and adopt early. Something that we've seen, or at least in my own client base, I have seen is my client early adopted because they did have a convertible instrument. And I think it took a minute to think through, well, we also have to implement the contracts in our own equity, and we've got these warrants over here. So now we've got to reevaluate the warrants too. So I think initially their gut reaction was, yes, we want the simplification on the convertible instruments, but it was a little more work than maybe they had anticipated initially, but greatly simplifies. So if this is something that you can benefit from, we definitely would expect early adoption. Now, what would a GAAP update be without discussing ASC 842 and the leases? So what's changing? Leases are going on the balance sheet, which was the objective of the standard setters, and the key difference under the new standard. All leases are going on the balance sheet, and we'll illustrate what that means in a few minutes. Some of you may be asking, what's the big idea and why did FASB think this was so important to make this change? As of the time of the issuance of the standard, the SEC estimated that there were 1.25 trillion off-balance sheet financing related to leasing arrangements. And this was due to the fact that the current accounting rules do not allow operating leases to be recorded on the balance sheet. And the bright lines in the current rules made it easy for companies to structure leases to make sure that they achieved the desired outcome, i.e. off-balance sheet financing. So as a result of this, FASB and the SEC and other stakeholders felt that the current rules were not giving financial statement users an accurate picture of the financial position of many entities, and those entities had structured a significant number of leases as operating leases, which resulted on them not being recorded on the balance sheet. And while the balance sheet treatment is obviously changing significantly with operating leases being placed on the balance sheet, the income statement does remain largely unchanged. FASB had initially considered going to a single income statement approach for all leases, where they all would have been treated similarly to capital leases under today's rules. However, through outreach with stakeholders, they determined that the financial statement users were accustomed to and liked the dual income statement approach and decided not to make a change to that. And we'll get into the income statement approach on later slides. Okay, so it's effective for fiscal years beginning after December 15th, 2021 for non-public, so your calendar year 2022. One item that we wanted to discuss a little further on this slide was the scope exception for leases with a term of less than 12 months. The short-term lease exception is a policy election, so it would need to be applied to all leases that meet the criteria of being short-term. To qualify for the policy election, the lease must be less than 12 months. And when determining that lease term, you will need to consider all the non-cancelable term of the lease, as well as evaluating if there are any renewal options or purchase options that are reasonably certain of being exercised. Determining if the reasonably certain, if renewal options, or purchase options are reasonably certain of being exercised is a subjective analysis, which is often going to require a significant amount of judgment. The chart on this page shows how to evaluate a contract to determine if the contract is a lease. And there are a few important items to note in this analysis. When determining if there's an identified asset, the asset can be explicit or implicit in the contract. An example of an implicit asset could be in a shipping contract if there's only one vehicle that can meet the customer requirements. So for example, if a shipment requires a refrigerated truck to be used and the lessor only has one truck that is refrigerated, then there is an identified asset even if the truck is not explicitly in the contract. The supplier cannot have substantive substitution rights in a contract if it is going to qualify as a lease. And then if it did, then the supplier would control the specific asset the customer is able to use. So both of the following must exist for substitution rights to be considered substantive. And if this criteria is not met, then the substitution right would not be considered substantive and a lease may still exist. So the first criteria is that the supplier has a practical ability to substitute an alternative asset through the period of use, and the supplier would benefit economically from the right to substitute the alternative asset. The other aspect that must be present for a contract to be considered a lease is that an entity must be able to control the asset. The standard defines control as the right to make decisions on how the asset will be used and to obtain the economic benefits of the use. If the contract specifies that the asset can only be used for specific uses, or the lessor can prevent the lessee from making decisions on how to use the asset, then the contract would not qualify as a lease. Many leases contain more than one lease component. So for example, multiple pieces of equipment. There's limited guidance right now on identifying lease components under the current accounting model. And oftentimes entities consider all of the pieces of equipment as a single component when accounting for the contract. The new standard provides additional guidance to help an entity determine when a contract contains multiple components that should be accounted for individually. There are also situations where a lease contract contains a lease component and a non-lease component. An example would be if a company signs a contract to lease a building and the contract also includes maintenance services in addition to the right to use the building. Under the new standard, the entity would need to separately account for the non-lease component. And in this situation, the non-lease component would be the service arrangement of the maintenance, and that would not be recorded on the balance sheet. So therefore, when calculating the value of your right to use asset and lease liability, part of the consideration would be allocated to the non-lease component and would not be included in your calculation of the asset and liability. While those are technically required to be accounting for separately under current leasing standard, in practice, this is not often a focus point because, as we had mentioned before, the accounting treatment for operating leases and service arrangement is essentially the same under the current rules. So as the new lease standard often requires operating leases to be recorded on the balance sheet, some entities will need to place additional focus on identifying and separating lease components from non-lease components in a contract. There are rules around how you would allocate that and determine the consideration. You would look first to observable prices, and if there were not observable prices, then the lessee would need to estimate. There is a practical expedient available that allows a lessee to account for lease components and non-lease components as a single component, and that is a policy election. But remember that if you decide to do that, it has to be applied to all leases. And it's certainly easier, but something to consider is why you might not want to do that is if you do elect it, your balance sheet gross up for the right to use asset and lease liability would both increase because your future minimum payment would be higher because you're including that non-lease component. So if you're not concerned about that at all, the policy election would likely be beneficial to you. So let's start by just looking at the balance sheet impact. And as we mentioned before, you will need to record a right to use asset and a lease liability for all leases. And some of you may be wondering why we're looking at the balance sheet impact before we've determined if we have an operating or financing lease. And the reason is that with the new rules, the calculation of the value of the right to use asset and liability is the same on day one for either classification. I generally find it easier to think about the value of the liability first. And this is because there are fewer variables in this calculation. And it's also the starting point for your right to use asset. So your liability is the present value of your lease payments. And the right to use asset is your present value of your lease payments adjusted for your lease payments made before commencement, lease incentive received, and initial direct costs. Both lessees and lessors will need to categorize your leases as either financing or operating. And the criteria is same for both parties, although there's no requirement that both parties get to the same conclusion. They should, but they might apply different judgments since there is no bright line. And from a practical perspective, given that the first 4 criteria are generally the same under the current standard, we would expect there not to be a significant difference in how leases are classified under the current standard and how they will be classified under the new standard. So let's talk now about the income statement impact. There are 2 approaches, and unfortunately you don't get to pick. The financing approach is just like today's capital lease accounting impact on the P&L, and the operating approach is just like today's operating lease accounting impact on the P&L. So this chart is contrasting the 2, and as you can see, there's higher expense in the earlier years and lower expense in the later years. And that's primarily a result of the interest expense associated with the lease obligation. In both situations, the total expense recognized will be the same, and the difference is the timing of recognition of that expense. And you'll notice that the income statement impact of these 2 approaches is essentially the same as what it would be under current guidance. And this just reiterates that the primary focus of the new standard and the project was to fix the balance sheet problem. So the difference in the timing of the expense isn't the only P&L difference, because there is also a difference in presentation. Specifically, when the lease is a financing lease, the expense is classified as interest and amortization. And that's important because the lease expense is part of operating expenses, while interest and amortization are not. So when you have a financing lease, the interest and amortization is going to be added back to arrive at EBITDA, while the lease expense on operating liabilities will not be. So in this example, while the financing lease would recognize higher expense in year 1 of $410,000, EBITDA would actually be higher by $2.5 million if the lease is classified as a financing lease. So given that both operating and financing leases would be recorded on the balance sheet, there may be less incentive in the future to structure leases to achieve an operating classification rather than a financing classification. Sorry, my computer's frozen here for just a moment. Okay. So this graph shows what we just talked through, where you can see the total expense is the same. Finance has higher expense in the earlier years, and operating is consistent throughout the term. Contrast this slide to slide 21. So this is now year 8 in my example lease. And in later years, the financing lease has lower expense than operating, as expense is higher in the earlier years. EBITDA is always lower in an operating lease. So based on what we just talked about, we should expect most companies to start structuring leases to achieve financing lease treatment, right? After all, we expect, if we have to recognize the lease on the balance sheet, we might as well have the expense classified as interest and amortization because we get a higher EBITDA. Unfortunately, it's not that simple. This may be the situation, but oftentimes companies were structuring these leases very close, where you were getting an 89.9 or 74.9 to achieve operating lease treatment. But now if your goal is to get financing treatment, you generally have to have a longer term lease. And then when you have to take into consideration the impact on your balance sheet of a longer term lease. So let's go back to our balance sheet, and in this time we're contrasting the balance sheet as it is today compared to implementation for a 10-year lease and post-implementation for a 15-year lease. And as you can see that having a longer term lease results in a significantly greater right to use asset and liability. And in our case, our asset and liability increased by approximately $8.5 million when we add an additional 5 years to the lease. So if we look at some of these ratios that we've calculated here with our current ratio and our debt to equity ratio, we can see the impact on the balance sheet of having longer term leases. When working through ASC 842, there are complicating factors to consider, such as renewal options and lease modifications, related party leases. So we're going to take a quick dive into just a couple of these. The first one is renewal options and when you would include the extended period in the lease term. You really have to look at that reasonably certain. You have to consider all economic factors. The standard provides some guidance on the definition of reasonably certain, but as we had talked about before, this is an area of significant judgment. This slide just details a few situations where you'd likely conclude either yes or no on reasonably certain. And this is just highlights how important it will be to have collaboration and communication between accounting, finance, and operations. The new lease standard changes the way lease modifications are accounted for. FASB felt the current guidance was too complex, so the new guidance is intended to simplify. And there's really two ways that you can treat modifications. You can treat it as a separate contract. And that would be if the lessee is obtaining an additional right to use and the increase in the payment is commensurate to the additional right to use, then you can treat that as a new contract. And if those two criteria are not met, then the lease must be re-evaluated. Another area of big change in the standard is related to related party leases. And currently they're accounted for based on their economic substance. The new standard looks to the legally enforceable terms. And FASB did that because oftentimes they're relatively informal and they don't always have legal contracts. So it can make it very difficult to account for those related party leases. So there are opportunities to work around here. If you have a 12-month lease with no renewal options, as an example, it would get scoped out. But just to highlight, you do want to be careful here when you think about the impact that this may have on your leasehold improvements. If, for example, you're using a 1-year term for your lease, you would also have a 1-year amortization period for leasehold improvements. So that can have a significant impact. So now I will pass it over to John to quickly discuss some strategies.
Thanks, Kara. Thanks for that excellent walkthrough. Really, that was really well done. I like the pace, and just when you think things might be getting easier, when we say, yeah, all leases are going on the balance sheet, it opens up a whole new world. But and also thanks for giving me the easy slides here towards the end, so I appreciate that also. So just a couple things on strategies. Obviously this is new GAAP, so it's likely going to impact financial covenant measures on your balance sheet. And I think if you're talking to lenders or have a loan renewal coming up, I think it's something you want to stay ahead of in terms of what the impact will be on EBITDA, income, debt to equity, that sort of thing. And make sure you understand kind of the pro forma calc for both sides of the historical, which might be under an operating lease, and the future, which might be under a financing lease. So keep that in mind. Obviously this is fairly straightforward, but the shorter the term of the lease, the less the future obligation, and the less the capital lease obligation will be, the longer, the bigger. Net leases, if you can negotiate a net lease, that might help trim down that liability and the corresponding right of use asset. Not always easy to do, but just some simple considerations. Can you go to the next slide, Kara? Yeah, so again, so nothing's fundamentally changed with the business. It's just a matter of how this multi-trillion-dollar obligation is going to now reside on the books of every company that has to present GAAP financial statements. So the slide references customers. We stole some slides from a presentation for that we did for a bank, and banks are becoming keenly aware of this. But again, if you stay ahead of it, if you're putting loan covenants together going forward that are quantitative, you could either suggest that they run the measure under the old GAAP, or make sure you're clear on what the future impact on the P&L might be. I think that the jury's out a little bit on whether or not these EBITDA adjustments are really EBITDA adjustments, and whether or not buyers and private equity and other investors are going to look at now a spiked up EBITDA for just a change in accounting. So I think we'll see that unfold as we go forward. The next slide. Okay. So just the highlights again. So leases are going on the balance sheet. Understand the impact again, so you can be transparent with your lender or other constituent users. Make sure you have a grasp of your leases. I think one of the things we're finding in companies is that leases and inventory of leases may have been a less controlled area because so many were either smaller, or maybe they were just operating leases and treated as rent expense. So this is also providing an opportunity to harness your leases that are in place. Don't make business decisions for the accounting purpose unless it makes sense for the business. And then employ strategies in lease negotiation to drive the outcome, not necessarily, if you can, in terms of shorter leases and net. And I think that was all I had. We did have some audit updates, which are probably worth a quick review. So for those that deal with audit firms, a quick snapshot of what to expect.
Yep. So there was just a suite of amendments that impact the audit standards, and they're largely going to impact the audit reporting standards. This is effective for your 12/31/2021 year-end audit. So doesn't likely impact you very much at all, but we wanted to bring this to your attention because you will see changes in the various communications that you receive from your auditor, as well as the structure and content of your audit report. So there's significant layout changes. They're moving the opinion to the basis of opinion section, both the opinion and the basis, move to the top. They expand the description of management's responsibility, including a new statement of management's responsibility regarding going concern evaluation. There are some optional disclosures of key audit matters, which is similar to what you would see in a PCAOB standard regarding critical audit matters. That's only applicable if we have been engaged to report on key audit matters. We do not expect many clients to engage us to do that, but that is an option. And then the required written communications, they clarify the required communications that affect the form and content of the auditor report and align it with the new audit standards. And then there's expanded communication on the risks and planned approach to address implications of the individual statements and disclosures. And then lastly, for any of you in the audience who currently require an audit to be performed under SEC independence rules, or contemplating a potential exit to a buyer that would require SEC independence, an IPO or a sale to a SPAC, for example, there were some significant changes to independence rules, and they were effective June 9th. And they could not be retroactively applied, but just a heads up there that there were some significant changes regarding independence, particularly focused on like the shorten of the look back period for IPOs and SPACs to 1 year.
Kara, we do have a question, and the question is, for leases in scope, can a materiality threshold be applied, or do all leases need to be included? Example, copier lease.
We get that question quite a bit. I personally have seen my clients consider those leases and if they would become material in the aggregate and put some thought around that. But for immaterial copier leases, particularly if we know they could never rise to the level of a significant number, we have certainly seen in practice where those have not been part of the 842 implementation. And then management was just sure to clearly document their consideration around that. And then, of course, monitor that for any changes in circumstance.
Okay, well, thanks, Kara. Thanks, Felicia. I just Googled new audit report.
You're on mute, John.
Mute, John. Not sure what happened.
Hey, Marty?
Okay, yeah, you were on mute, John.
Oh, okay, I wasn't sure if you guys did hear me, but I was just trying to wrap it up before I turn it over to Marty, but I did just Google new audit report and it came right up. So I was able to get an idea of what it is, and it is substantially different. So if anyone wants a heads up on that.
Okay. And I'll jump in here for a second then too. First of all, I guess I have a couple more questions here. Any insight in what's driving the new audit report format?
Yeah, I think the idea was moving the opinion to the top, and the basis for the opinion to the top was more sense from made more sense from a reader, flow perspective as far as because it's really just moving kind of landscape around. So I think the idea was kind of get to the point first with the opinion.
I would just add to it that there's more transparency around what the auditors do has been an ongoing trend. And I think so the new audit opinion, just it kind of gets the opinion out of the way and then talks about other things like key audit matters and responsibilities of management, clarifies areas of focus in the audit. So it's intended to give a little more insight as to what the auditors did and what they view as important.
Okay, and we've got a comment here. I think it's addressing the question about copier leases. The comment is immaterial leases can be excluded. And the person writing this says discuss with auditors for concurrence. So that's basically the same thing that Kara had just mentioned. Okay, not seeing any more questions. I just have one comment. I saw something's going to be coming out from the FASB in the fourth quarter. It's been voted on, but it's making its way to a final standard right now. And that's a concept that I know is real big in the industry I'm in, software as a service. I'm at a SaaS company and have been for a number of years. with an acquisition, the GAAP has been, you have to reduce your contract liability, your deferred revenue balance to fair value.
Right.
And that's reducing it to the cost that you would, to the liability estimate that you would have going forward. So say I've got $1 million sitting in deferred revenue, and the estimate of the cost going forward is only 25,000. What did I say? 100,000? 25,000. That 75% would be a reduction on your opening balance sheet for the acquisition. And what's happening now with this new standard is that it'll follow more the ASC 606 revenue recognition rules, where you would keep that full balance. It's subject to making sure it conforms to your GAAP and everything else, but basically you would no longer have that haircut. That's a major thing. Here we go. So people should be aware of this. It's supposed to be coming out in the fourth quarter, and if you haven't issued financial statements yet, this is something that you could apply to any 2021 acquisitions that haven't been in the subject of the audit report yet. So this is something you definitely want to keep your eyes out for.
Yeah, Marty, it's a great point. And this is really coming from the fact that ASC 805 didn't have contract asset or contract liability within the standard. Those didn't exist at the time that 805 was written. So this is really addressing that and trying to eliminate divergence in practice and, or like you said, more closely aligned with 606.
Okay. Kara, can you send this to Susan, and she could send it out with you?
Yeah.
Well, I think she's going to send out the evaluation right away here, so maybe separately, but that's something that people should be aware of, and it is coming up here in the fourth quarter. I know it's something major that I want to keep my eyes out for.
Yeah, sure. Happy to send this along.
Great. I'll wrap things up. Susan will be sending out an evaluation to people. So make sure you do that, and in that evaluation also request CPE from Susan at that point in time. I'd like to thank Plante Moran for the great presentation today. I've wrote a full page of notes here, things that I want to make sure I follow up on. So thank you all very much. I found it very interesting seeing some comments to that regard in the presentation as well.
Thank
Thank
you.
you very much.